Hello and welcome to this week's Australian Stock Market Report. Now this week, we're going to look at whether October really is a down month or is it just a wives' tale. We also take a look at S32, PTM and other stocks. Then we'll get into the Australian stock market so I can share with you my thoughts on where it's heading, along with answering your questions and looking at stocks for you. Hello, I'm Dale Gillham, the Chief Analyst here at Wealth Within, and we're Australia's most trusted stock market educators. Now, before we move on, thank you for showing your support for our channel and hitting that subscribe button. Now, remember, as you subscribe, click that bell on the right of it so you keep up to date with our latest videos. Also, remember to tune into our live Australian stock market show, which is on every Tuesday, 7 to 8 p.m. Australian Eastern Time. Now, this is the show where you get to ask us, the stock market education and trading experts, to look at your favourite stocks and answer all of your questions. Now, it's common for investors to blindly follow the herd, and all too often this means they are generally more focused on receiving income rather than gaining capital growth from their stocks. Now, smart investing is not about income alone. It is about the total return, as chasing a 7% income whilst your stock is falling 20% or more simply doesn't make sense. Now, we've seen many times in the past where investors give up much more in capital than they get in income, with Telstra being a prime example of this. Now, Telstra fell 72% over nearly 12 years between 1999 and 2010. And then after rising over 4 years, fell another 61% between 2015 and 2018. Now, all the while investors held the stock to gain a dividend, and many long-term Telstra investors would be very lucky if they were in profit on this stock, especially if we factor in inflation. Now, investors are often encouraged to hold real estate stocks and REITs long term so as to receive dividends, and this has not really been a wise strategy this year. A study of 45 of these stocks shows 40 are in loss since the 1st of January, with the average loss being 20%. Now, the average dividend yield on property stocks is just over 4%. And so investors are going backwards in holding these stocks. With the current challenges around commercial property caused by COVID and workers preferring to work from home more, I suspect we may not have seen the end to the downfall in real estate stocks and REITs. Now, whilst I'm not suggesting this area will be like Telstra and fall for 10 or more years, we do need to be mindful we are investing for profit. Regardless of the direction a stock price is going, we also need to remember that a company can reduce or suspend dividends at any time, which they did during the COVID meltdown. Further, we need to remember that the more the price of a stock falls, the higher the dividend yield is, and that this is often used to tempt investors into buying and holding these shares in an attempt to suspend the fall of a stock. Given this, it's wise to understand that a high dividend yield may not be the opportunity you think, as you could be catching a falling knife. First and foremost, investors should focus on stocks that will rise in value before considering any dividend yield. Now it's time we get into what were the best and worst performing sectors last week. Well, the best performing sectors, they included energy, and that was down 0.46%, followed by utilities down 0.47%, and financials, that was down 0.54%. The worst performing sectors included healthcare, and that was down 4.06%, followed by industrials, and that was down 3.60%, and consumer staples, that was down 3.09% last week. The best performers in the S&P ASX Top 100 stocks included the Star Entertainment Group, which was up 9.02%. That was followed by AMP up 7.08%, and Computershare was up 5.65%. The worst performing stocks included Atlas Arteria down 17.42%, followed by Lynas Rare Earths, and that was down 11.66%, and Evolution Mining, that ended the week down 10.96%. Now's the time for you to do your bit and give us a really big thumbs up. That means just drive your pointer down there or your thumb down there and click on that like button now. So, as I said, if you are at this point of the show and you do like what we do, give us a thumbs up. So, what do I expect in the market moving forward? Well, let's get into the charts for our S&P 500 All Ordinaries Index update this week. We'll also answer your questions and look at the stocks that you've chosen for me. Well, it wasn't last week an interesting week. It sort of started to unfold like I expected, or I thought it might, but Wednesday really changed all that, with the Dow falling quite heavily and taking our market with it. Earlier on the week, our market was up quite nicely and continued to rise from the prior week, or the last Thursday, Friday of the prior week. So it did look like we'd had the low. But that said, has the current move, or last week's move, really changed my opinion on what I think the market's doing? Let's go and look at the charts, and I'll tell you what I'm thinking about, not just for this week, but for the next few weeks. But let's get into the charts right now. On the screen is the weekly chart of the All Ordinaries Index, and I just want to share with you a little bit about what happened here last week. And you can see here it's a green bar. I've just made these a little bit more translucent, these old arrows, so that you could see exactly what went on. And I just want to show you a little bit about what happened last week. If I take a couple of days off, you can see there earlier in the week the market had moved up beautifully, and then obviously Wednesday happened and it just really did pull back Thursday, and then obviously Friday, where we closed right on that support level that I did share with you a couple of weeks ago, saying I thought our market would fall down to either one of these two levels and finish out its downward move. So technically last week was an up week. Let me just turn the training off. Was an up week because it did rise and it did break the high of the previous week, and it didn't close lower or didn't trade below the week prior. So what do I expect this week? Look, I wouldn't surprise me if our market had an inside bar this week where it was, we traded up this week. Maybe we would get a green bar to go above the high of this one, 7258, but maybe not. But it does look all right. I haven't given up my thinking that our market has had its move down and it start to move up. That said, as I said the other week, I'm still prepared for it to go down around that 68, 6900 points area, and then have an ending and then take off from there. But I still, even though the Dow is a bit weak and the Dow had that reasonable move down last week, I really haven't changed my mind. Last week we had the financials are only down slightly, as you just heard a little bit earlier in the report. Materials were down a tiny bit more than that, but really the more was the energy stocks coming off a little bit. So I didn't see broadly our market was super bearish. So as I said, it wouldn't surprise me if our market had an inside week where it just sort of traded within this previous bar here from last week, traded within the range of that, and then we slowly moved on up from there right up through this sort of high there at 7,386 points and go on for the rest of the year. But I'm just going to show you the Dow, and the reason why I'm saying it. Have a look, just burn this into your memory about what's happened here on our marketplace. And then I'm just going to show you the Dow Jones. Now, I showed you briefly last week the Dow Jones and have a little bit of a look. But look at the Dow Jones. It's a really heavy bar here. So we've had 1, 2, 3, 4 weeks down through here. And it had a bit more, two weeks down through here before rising. Remember, ours was 8 weeks straight up. And then it come down, rose, had a green bar, and then come back down a little bit last week. But the Dow is much more bearish, so I would expect the Dow to go below that low of 29,653 quite shortly. You never know, it might find support around that level, but I do think the Dow is weaker than our market, and that's the issue. And what I'm saying is a lot of people think just because the Dow's going up and down that our market will do exactly the same thing, and it's not necessarily a good assumption to have. Whilst we do go down in bigger moves with the Dow and all the S&P 500, we are different markets. We're much more materials heavy and financials heavy, our market. The S&P 500 is much more technology heavy, and the Dow is a mixture of a whole lot of different stocks, not necessarily technology or financials, even though both of those are in the Dow. Remember, the Dow's only 30 stocks too. So we are a different market. So whilst I think our market would be more bullish, we're changing the guard. The Dow outperformed us the last 12 or 18 months. It has outperformed us, but I think our market will now outperform the Dow for the next 12 or 18 months. So it does switch like that. And if we look over history, and Janine and I have done this before on our live stream, which is on Tuesday night. We've done this before where we've compared the US market and the Australian market, showing you that you can't always expect our market to do what the Dow or the S&P 500 is doing. Because it's right now, I'm not really worried about our market. Now, some people may say, hey, Dale, you're crazy. The market's falling away. It's going to be bearish, etc., etc. But right now, I'm not seeing that. I'm thinking our market will be finding support and starting to move up towards the end of the year, and possibly right up through into January and February next year. So, hey, but only time will tell, and I'm prepared to be wrong. But right now, I strongly suggest people, until we understand the direction of the market, whether it is up or down, because I am prepared for it to go down, that we make sure that we do understand that we can't confirm direction right now, but when we do, we'll know what choices to make. But we should already have those decisions already, like have stop loss on our stocks or exit strategies on our stocks if the market and our stocks actually fall away. But we also have entries for stocks, and we have already done the research on stocks we're looking to buy if it does start to go up, and stocks we're looking at start to go up, because I have quite a few stocks on my buy list at the moment of stocks. If they do X, then I'll start to buy them. But I've also got stocks on my list that I own that I've also got sell signals on just in case it goes down. I'm covering both bases, and that's what I suggest you do. But that's it from my market report. Let's get into your questions. But before we get into your questions today, really what I wanted to suggest is if you're one of those few people that are still not taken the opportunity to get a free copy of my first book, which is called How to Beat the Managed Funds by 20%. And I'll just grab it here just so you can have a look at it. That's my free book. It's my first one. It's a best-selling book here in Australia, and it's like, I don't know, 20 or 30,000 copies. I can't remember. I've just lost count of how many copies are out there, but you can get that for free. You've just got to pay the shipping, which is about $9, I think, for us to ship it out to you. And you just go to our homepage on our website, and once you're on the homepage, there's a big button there. You just click on wealthwithin.com.au and the big button there, click it, and we'll be able to send the book out to you. So you can get that for free. So please make sure you get on there. And it's a really good book, especially for times like this when the market's a bit more volatile. And I've had so many emails this year, and not over the years and decades actually, that this book's been out. I think I wrote that about 2004. And then I revised it, and I still get comments today from so many people saying how it's helping them get better entries on their stocks, take away that fear that they have, help them allay that FOMO, help them understand what they need to do, how to construct their portfolio, how to buy, how to sell. There's so much in that book that will help you for $9. It's pretty dirt cheap for something that's going to help you make a lot of money. But let's get into the questions that you have for me. The first question we have today is from Dennis. He said, a lot of investors tell me October is a down month. He says, do dividend payments from reporting season help cause that by taking funds out of the market short term? There's a lot of things that you shouldn't do, and things you shouldn't listen to. And that's probably one of those things that you shouldn't listen to. I've done the research, and October's not necessarily a down month. And it's one of those wives' tales that I find that, there's other ones, like sell in May and go away, and a whole range of those sorts of things. And the reason why they say October is a bad month is because pretty much we've had a couple of big crashes. Obviously the 1929 crash, the big days were in October, although, our market bottomed in 1931 and the Dow bottomed in 1932 from memory. So most of the falls happened around outside of October anyway. The 87 crash was October as well. And so we hear that month on those two big crashes, and we just assume that October is a bad month, and not necessarily actually. A few years ago I went and did the research. I went back over about, I think, 30 years of Octobers, or all months basically, and looked at all the worst months in our marketplace. And September had more lows, or was more down than October. September and November were more down than October, and I believe, and don't quote me on this one, I think even December was more bearish than what October is. And so you need to be careful about that. But we do have reporting season. We've just finished it here in Australia. We do have dividends, and that does take some money out of those stocks, and so they do drop away. But it doesn't necessarily cause October to be or even September to be a bad month. It generally is. It's just how the market works. There's a lot of things that are involved in the market, because institutions do pay dividends. They also do have other returns. We have withdrawals out of managed funds. We do also have tax things that they do things for, and they do portfolio allocations and restructuring. Obviously, we have index reweighting on a quarterly basis as well. So stocks will go in and out of the top 20, top 50, top 100, top 200 stocks. So there's a whole range of mix of things that do cause the market to move around and more money to move in and out of a stock. But don't just assume it's October. Okay, now we get on to a question from Shane, who says, "G'day Dale, can I please ask your thoughts on PTM? Not a pretty chart at all. However, I've traded this successfully in years gone by and in similar parts of the economic cycle, as I believe we're entering now. Now, I've completed my fundamental DCF valuation, but waiting a confirmation signal from the chart. If it was to push past $2.20 on volume, does it become a maybe, Or is this just one too tricky to tell? Love the show. Thanks, Shane. I'm going to get in and have a bit of a look at this one. On your screen is PTM, which is Platinum Asset Management. And you can have a look at the stock. It's been pretty bearish of late, as you can see there. But look at this stock. It's quite an interesting stock. It has big, large falls all the time. And right now you would think that this is probably going to fall a hell of a lot further. And he's saying $2.80, which I'm probably assuming it's probably somewhere around about, there's $1.93. So I'm not sure whether he's got his $2 odd mark there. But at this point in time, you need to assume it's going to continue to be bearish. But let me bring up the weekly chart on this thing. And you can see here that we've seen this big move down over the last 3 weeks. We've got that high there of $1.71. Here's the more recent high there of $1.93. So I think, you know, it's one of those tough ones. This could be the end of a run. So there's $1.55. It's $1.55 and $1.59. So you've got this really nice solid little bottom here. Now we're only talking a few months here from June right through to September, so it's not as solid as you know, one that's 10 years apart, but that looks pretty solid. So to me, you know, if it did break through these highs through here, then I think that's a good sign that it's going up. From my point of view, but I don't know the rules that you have. But again, I'd need to do a lot more price analysis on it, because if you look at this, I'll go back to the monthly chart and look at this. It is possible. This $1.55, this is its lowest point in history. So we still need to be careful, because the feeling around this stock wouldn't be very, very positive with its investors, because if they've been buying and holding and hanging on, you know, obviously they would be not very happy about the return on that share price at the moment. So this little move up here could be just an aberration at the moment before another move down. And that's why we continue to say is always make sure, err on the cautious side, because you're always going to get move up before another move down, another move up before it moves down, moves up before it moves down again. So is this just 1 or 2 bars up before it moves down and breaks that? So you need to make sure whatever rules that you're using really give you a confluence to say that this is strong, it's really found some support, and it's going up. And as I've said in the past, I would rather give away a big chunk of money on the bottom here just to make sure I get it right. Because if it does start to trend well and might go up 200 or 300% on you, is giving away 20 or 30% off the bottom better to know that you're getting in a stock that's moving up rather than guessing? And all too often I find people guess. I'm not saying you're guessing at the moment, because I don't know all your full analysis on it, especially technical analysis on it. But often people jump in too early because they want to try and get the lowest possible price, you know, and that's really what I would call bargain shopping. And you can't do that like you can do at a supermarket or at the shopping centre. You can't just bargain shop. What you need to do is confirm that it's going up, and you know it's going up with a high degree of probability. And I believe that's what you're trying to do. So good on you for doing that. But I just err on the cautious side a little bit on this one and make sure it's moving up and you've got some strength there before buying into the stock. But it is really, really good that you've done all of that. But let's move on to the next email. And this one is from somebody called New Ideas, and they say, thanks for all the analysis and videos. Would you mind talk about S32 market predictions and analysis in future videos, please? Thanks again. We highly appreciate all your hard work. Janine and I talked a bit about S32, I believe, last week on last Tuesday night show, and we talk about it, or have talked about it a lot over the last 6 months, I think, but I'll go and have a look at it now for you. But you might want to have, you know, as I said, I believe Janine and I talked about it last Tuesday, so you might want to go and have a think about or look at what we talked about here. Now, S32 has been a beautiful, beautiful stock, and you can see there, you know, beautiful trending stock, easy to trade. I've traded this myself. I'm currently not in this stock myself, but I'll be waiting for another opportunity. But looking at that, this to me just looks like a bit of a short-term move before it falls away again. And at this point on the monthly chart, it just does look like that, because it does need to hold to really come back to a little bit more of a consistent sort of momentum. But that said, I'm not really saying it's not going to be bullish more medium to longer term. But if I use my little trend line here, I'm probably talking a little bit cryptically, but you can see here it really just came back to its sort of momentum through here. So it wouldn't surprise me if it came back down to here, or even back down to this point, or even a bit lower down into this sort of $2.80 range. But that looks quite bearish to me. And so it could be just a little bit of run up before it falls away. That said, if it was to find some sort of support above that $3.40 and start to, you know, really trade sideways or trade up a little bit, I'd get a hell of a lot more interested in this stock. Rather at the moment, I think it's time just to sit out of it a little bit, just be careful. It's a great stock. I don't have a problem with that. And as I said, I've traded it myself, not in it at the moment for myself, but watching it and waiting for this. This is one of the stocks I do have on my personal watch list for myself to get into. And I know Janine loves this stock at the moment, but just sit back a little bit and be a little bit careful. Before I get into the next question, I want to make a comment on last week. Now, I know last week somebody asked me about information and where you get it from, and how the charts that you use. Not all of us could. Somebody said we can't all buy the professional software like you do, etc. And they asked where, and I mentioned a few trading portals, or it's not a trading portal, a few platform portals that are free, where you can get free charts, which is what the person was asking. I said, these are just great for free, but serious traders won't generally use these. They'll actually use proper software like what I'm using, and there's plenty of other really high quality software out there around in the world. This one just happens to be Australian, the one I use, which is called Optima. It's Australian, but I had a skeptical, can you say that? Skeptical person came on and with a comment saying that I was, that I was being self-serving, etc., and that we make money from promoting the software and everything else. And the comment's been deleted because it was A, it was wrong, and B, this is not about, if you're skeptical, go somewhere else. Go and watch somebody else's video. If you're a negative person, go somewhere else. If you want to trade high frequency and all sorts of other stuff and you want to make negative comments, just go somewhere else. Watch somebody else's videos. It's a real positive environment, but the person was wrong. We've never, ever, ever, ever in the history of any of these videos ever promoted Optima for anybody to buy. You can go back to every single video that we've got here in YouTube and see if there's a link to Optima to buy it from anything that we get referral fees. We get zero referral fees or commissions from anybody anywhere in the world. So we do not promote any product. We do not promote any platforms. We don't promote any data feeds. We don't promote any brokers. We don't promote anybody, and never ever have. And in fact, pretty much nearly every week, at least every month, I get approached from a broker, and on Friday I got approached for a new platform that wanted me to pay they wanted to pay me 25% of the fee that you would pay to them if I referred them to you. But I don't do that because you're smart enough to work things out for yourself, aren't you? If you've got education, I don't need to get, or we don't need referral fees from anybody. And so that person that posted that, you're 100% incorrect. This is not self-serving. I just don't use free platforms because as a professional trader, why would I? I want the best tools around me. When you're a craftsman, you get the best tools and everything else. If you want to use platforms like that as an investor, I don't have a problem because it does a lot of the same things that the software that I use does. It doesn't do it as well. It doesn't have as many tools or things that I use, and but it's an online portal too. And sometimes you're better off just buying the software anyway. But why I use this, it's Australian. It's simple as that. It's an Australian product, and they get great service, but we don't make a cent out of it when we put it if you're becoming a student of ours in our diploma course or our short course, one of those two courses, we actually buy the software for you wholesale to save our clients money, our students money. We buy it wholesale and don't charge them another fee. So we make zero money out of Optima, and you're quite welcome to ring Optima yourself, whoever this person is. And anybody watching is quite welcome to ring Optima today, tomorrow, whenever you want, and say, hey, do you ever pay wealth within any commissions? And see what they say. Because it's not about that. We want to try and stay, I was going to say apolitical, but impartial is the other. If you want to use ComSec and you want to use Saxo Bank, or you want to use FP Markets, that's your choice. To me, I don't get involved in all of that. What we're about is teaching you how to trade properly and be sensible on the marketplace and make more money. That's what we do. So yes, I'll promote my book. Yes, I'll promote my 2 books. Yes, I'll promote some DVDs. And yes, I'll promote our courses, because our job is to teach you to make the best decisions about how to trade and invest for yourself. But if you do want information on our courses, this is a plug, if you do want information on our courses, give our team a ring, 1300 858 272, or just go to our website, fill out the inquiry form. You can go under Education tab, click on Courses, and you'll be able to fill out a little form, and our team will talk to you. And they're all traders themselves, and that's how we do it. But we don't make money any other way as I said, we don't make money from other companies giving us commissions at all. So that's all I'll say on that one. But I will move into the next email, which is from Kylie, who says, when you said index funds will be at the forefront of the crash, do you mean funds such as Vanguard conservative index funds, or do you mean other ETFs and the like? Many thanks. Yet it's index funds, which that would be a part of it. And I'm not saying they're going to necessarily cause the crash, but they're going to be part of the crash, if that makes sense. Because the analogy I used was, you know, if you've got all these roads coming into one, you're going to have traffic jams. So, for example, let's say Vanguard have 300,000 investors in that fund, you know, and let's say 30% of them, the market's crashing and 30% of them want to get out. That's 100,000 people wanting to get out of that fund pretty quickly, because you can trade it on the market. So, but they're in their fine print, and I'm not specifically talking about Vanguard. I'm talking about all ETFs have fine print. Read it, what happens and what they can do, because what they can do is stop quoting it on the ASX and suspend it and all sorts of other things, where you can't suspend BHP. BHP board would have to go apply to the ASX to suspend trading, and they'd have to have a reason, which would be something like, there's some time sensitive information that's about to come, so we're going to suspend our stock. But that doesn't have a benefit to BHP itself, you know, because the secondary trading of stocks, if I'm buying BHP and you're selling it, BHP don't benefit from that, because the ASX just transfers the stock between you and me, in theory. That's high level. Whereas when you're talking about an index ETF or ETFs, is the ETF provider does things in the background to provide that product for you. So they create their product. So they're either buying the stocks themselves, or they're hedging themselves, or offloading their risks somewhere else. So they've got to unwind all that. And that's really what I was saying, is when you get a huge pipeline of people trying to exit and withdraw funds, you're going to get bottlenecks, and that means you're going to struggle to exit at good prices and those sorts of things, because these players, like they did with the managed funds, they'll just say, oh, hang on a second, we're just going to stop doing this for a bit, because we need to work out how we're going to, you know, save our money, basically, not necessarily not too worried about your money. And again, I'm not making any judgments on Vanguard or any ETF provider. I'm just saying, with the amount of money going into index ETFs at the moment, which is squillions of dollars, that's only going to snowball to be bigger and bigger and bigger. And the bigger the ball gets, the harder it is for all the people that make up that big ball to get out when they want. And you can't tell me that people don't panic when the market's crashing, because they panic faster nowadays than what they did back in 87, when we didn't have all the computers. We just saw how fast that COVID meltdown was. We saw how fast the GFC meltdown was. So again, I just hedge my bet. Right now, I'm not suggesting our market's going to crash at all. So please don't think that. I think our market's pretty good. But in a few years, when it does start to crash, and if there's, 2, 3, 4 times the amount of money in index ETFs by then, and that's why I was saying to you, we need to look at how much borrowing's going into the marketplace. And when the borrowing starts going through the roof into putting money into things like index ETFs, that's a sure sign that the end is nigh, and we should start to pull back and not worry about that last run up on the marketplace, but protect ourselves. So hopefully that makes a bit more sense for you, and I've explained it properly. But thank you for asking your question, and thanks to everybody for sending in their questions. But unfortunately, as is the case each and every week, we seriously can't answer everybody. But remember, the best chance to get your question answered is to publicly subscribe to our channel. That means you've got a little red thing next to your name. That way I know you're publicly subscribed, or you're subscribed to our channel, because that's the only other way I can figure that out. Type your question below once you've done that. Give us a big thumbs up, and I'll actually answer your questions. But remember, we do these Monday market reports each and every week. We also do a live stream every Tuesday night, 7 to 8 p.m. You can give Janine and I a call and have a bit of a chat with us tomorrow night. The number's 92909988, 92909988. That's Melbourne, which is 03 at the front. So be online tomorrow night, 7 to 8 p.m, and you'll get to see us. Remember, hit that subscribe button now. Click the bell on the right of it so you know when we upload our videos and go live. And remember, give us a big thumbs up. That's it for me. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck, and good trading.